Hello everybody. So today's video is entitled Big Orange, Big Stretch, because likely the big orange that he announced this morning is due to big issuance of STRC preferreds. So it's a surprise to no one, of course. He bought more, signaling a big signal, right? Bigger orange. That's about the extent of the news here. There's more things that I want to talk about. I want to talk about Stretch. I want to talk about their update, the BTC Rating. The BTC Rating is now prominently featured on strategy.com. That's a new update that they have. And I want to call your attention to this chart. It increased. You can notice the Stretch BTC Rating, it's 6.4. So that means that for each stretch, each $100 of stretch, you have $640 worth of Bitcoin, as the value of Bitcoin is right now. $640 worth of Bitcoin backing each $100 liability behind Stretch. And so, of course, the whole reason as to why Saylor believes Stretch should be trading at a much higher price is because you have Bitcoin backing the debt. You don't have, Starbucks with a bunch of cash flows backing that debt. You don't have GM with a bunch of overpriced trucks, leases buying that debt, backing that debt. You don't have an over-leveraged family who maybe have lost their job, who bought too big of a house, and their ability to pay the mortgage is backing the debt. The debt is not backed by cash flow. The debt is not backed by some business endeavor. The debt is backed by the hardest asset on earth. It's backed by Bitcoin, and it's backed, more than 6 times for Stretch. And that's why Saylor believes that Stretch should actually be yielding way less, right? Stretch should actually not be yielding this much. It's an anomaly. It is due to the fact that the market still does not understand Bitcoin. Of course, as Bitcoin goes up, this BTC rating will go up. And so, if Bitcoin doubles, that means your Stretch BTC rating would be a 12. And so what that means is that as Bitcoin goes up, it can issue more Stretch, right? And I think over the long run, and Saylor said that before, a BTC rating of 3x to 5x over the long run would be just about right. And so what that tells you is that there's way more issuance of Stretch coming. In fact, if we want to get Stretch down to a BTC rating of 3, right, and Bitcoin stays at the same level, we have to double the issuance of Stretch. And so that would be what? Maybe $4 billion, something like that. So anyways, that's the new chart. That's a good thing that he added that BTC rating is essential to understanding how undervalued these debts are. These preferreds are undervalued because they are trading at highly safe levels, right? Bitcoin would have to drop a lot, and you would still, if Bitcoin dropped more than 80%, right? If Bitcoin dropped, 90%, you would still have about 1-for-1 collateral Stretch. That's how safe this asset is. Not quite, but you know what I mean, like 80%. So it's pretty crazy, if you ask me. I think it's pretty crazy. Does he use Common ATM? Did he use Common ATM last week? The answer is maybe. The answer is likely. He likely used the Common ATM a little bit. Why would he use the Common ATM? Because over the long run, this supports Stretch BTC rating. The more Bitcoin you have as permanent capital, the more these BTC ratings increase. Did he use Stretch this week? You bet. Yes, he likely used Stretch this past week. So we know the week prior to that, he was able to do 30 million. So 30 million times 4 full days of issuance, 120 million. I would say it's likely more. 120 million is likely the minimum that he issued on Stretch this week. And looking at the Stretch chart, this is where we celebrate, right? Looking at the Stretch chart, what do you see? You can see most days, aside from Jan 15, which was the ex-dividend day. It's the day that people could sell Stretch and still get the dividend. You had a sell-off. This sell-off every 15th of the month, that's probably something that's going to keep happening because you have people who are dividend arbitrageurs. They buy it the day before, they get the dividend, and once the stock goes ex-dividend, they sell it right away, and they harvested the dividend. That one day, mid-month, is always going to be a thing, but nonetheless, we recovered right away. It took us about a day. It took us about the day to recover. and that was heavily noted by analysts how quickly we recovered. And then, the day after, we were past 100. So 4 days out of 5, heavy issuance of stretch. We heavily traded above 100 again and again. And of course, the key to getting the stretch preferred back to 100, the key is issuance. He has to issue a bunch of stretch shares in order to keep the price down. And that's what he did, and that's how he raised the funds. Moving on. Another thing to say about stretch. So this may have not been seen as much. I didn't see this trend as much in the MSTR community, but I think this is a pretty big deal. There's a group of VCs, right, or venture investors, who are launching a USD-AT. So they're launching a stable coin, which is called USD-AT, and that stable coin that they're launching, on blockchains, right? So on starting with Ethereum, but likely on Solana as well. It's gonna be USD-AT, which is the digital version, right? The digital finance version, the blockchain-based version of Saylor's STRC. And as you know, I've called STRC, I've called it before a TradFi, so traditional finance Santi stablecoin, because it trades at $100. It doesn't trade at $1. So they're taking a version of that coin, that stablecoin that Saylor issues, STRC, that is on old financial rails, and they are creating a token, and that token is going to be trading on digital financial rails, going to be trading in DeFi, and they're starting small with an angel round under $1 million, but in my view, this is going to be a big deal. This could catch on quite a bit. And of course, this is similar to the conversation of banks getting worried about their deposits yielding 0% leaving. I think it's fair to be worried. And in fact, the deposits at banks may leave because people just buy stretch in their brokerage account, by the way. Some of these deposits could be taken away by brokers, right? Robinhood you could have a TradFi innovator, an innovator on TradFi rails, who actually takes away these deposits from legacy banks. But you also have the even more modern version, which is the blockchain rail, which is a lot of people, Gen Z already do that. Gen Alpha will only do that, in my view. They just skip the bank entirely. They just deal with Coinbase. Coinbase is their main financial partner. Every time dollars hit their bank account, their job, whatever, it just gets converted into USDC. And USDC, of course, pays a yield on Coinbase. If you have USDC stored on Coinbase, you already earn a yield. Well, what's going to happen is that maybe they're going to be like, okay, well, I'm gonna be getting my paycheck in USD-AT. And so that's already happening. They're creating a stable coin based on stretch, mostly stretch. They're gonna have a little treasuries in there in order to keep it flat, and that solves the problem, by the way, of like we said before, like I've said before, stretch is almost gonna be 2 to 3% volatility, because you're always gonna have that problem mid-month, right? And you may still have a few bear markets here and there. So we're still gonna have a little volatility. By turning it into a stable coin, it's entirely possible that the USD-AT stable coin is actually going to trade at $1. It's entirely possible. So I think this is a pretty big development, and this is, of course, in line with the fact that the banks are fighting. This is Saylor retweeting Brian Armstrong. The banks are fighting against tokenized equities, but they're especially fighting against yield on checking accounts. Yields on checking account. They don't want you to earn 11% on your checking account. Well, that 11%, by the way, is a nascent yield. Over time, as people realize the power of instruments and Bitcoin-based instruments, these yields, in my view, will drop, at least for the time being. They're going to stay high, but they will drop eventually. Maybe 5-ish%, maybe a little more, maybe 7%. They'll drop, but people will be like, okay, well, my checking account should yield 7% or 6%. That's what it should yield. It doesn't yield that. Well, guess what? What's the delta? The delta is that, and the banks, of course, lending that money. You have 10,000 on your account. The banks, of course, take that 10,000 and they earn 6% or 7% on average, because the average is of course mortgage debt, but it's also credit card debt. But obviously, we know on this channel that it's even worse than that, right? Because we don't live in a full reserve system. We live in a fractional reserve system, and so really they can take that $10,000 and before the Fed removed the requirements, they could leverage it up 27-1. So now there's no such thing as 27-1 leverage. It used to be if you had 10,000 on your checking account, the bank could lend at 270,000. Now there's no limit anymore. The Fed still hasn't put that back. So now the banks can lend unlimited. It's just a matter of risk. How much risk do they want to take? What is their taste for risk? Don't forget, money printing mostly comes from the commercial banks. Yes, the Fed prints money too, but the Fed is usually the secondary money printer in the economy. The first money printer in the economy is the commercial banks. When the commercial banks lend $500,000 to someone for a mortgage, it's money printing. Make no mistake about it. It is money printing. Yeah, sure. Often they equitize it and they do a mortgage-backed securities and then they resell it on the back end. And then you have the Treasury Department or you have the Fed buying that on the back end. But it is money printing. It is double entry accounting. It is fractional reserve. So, anyways, sorry about the tangent, but that's going to change a lot of things. I think this is a big deal. And I will conclude talking about this heated interview once more, which wow, the number of comments I've seen on X, I've seen on YouTube about this interview with Danny. So Danny took over the What Bitcoin Did podcast. Anyways, British based or Australia based podcast, doesn't matter. Like a lot of people are getting shocked by the tone, and me, I try to not judge the tone, but you got to realize that some people can't get past the tone. It's like sometimes, like where I live, there's a lot of people who have like a very thick Southern accent. They think if you have a thick Southern accent, it means you're dumb. But no, you're not dumb because you have a thick Southern accent. It's just an accent, and so people sometimes can't get over the tone. That's why some people say, oh, if you're British, you sound smarter. Like, okay, the tone doesn't matter. I'm not going to judge the tone, but I know a lot of people were very upset about Sailor's tone, and a lot of people were saying, oh, Sailor's being disrespectful, etc. You have some people who do this, who think the same about like grammatical mistakes. You make a grammatical mistake, they will judge you to zero. They'll be like, you're worth nothing. So anyways, I just judge the arguments. Oh, sorry about the tangents today. I just judge the arguments. As Stephen Livera says, there's 25,000 management firms, 15,000 companies, 9,000 commercial banks, but there should only be a handful of treasury companies. And of course, the criticism being, I think there's something like 80 treasury companies or something like that right now. And Sailor's point, and I entirely agree with him, is like Bitcoin is a invention. It is a core invention of the modern era. It is a new economic invention. It is the invention of undisruptible money. It's the invention of unalterable money. It's an invention. It's something we invented, like double entry accounting, which if you ask me was a pretty bad invention. It's an invention like steel, like electricity, and these inventions often are akin to discoveries. We discovered something. So no matter how you call it, every company adopted steel. Right? There's no such thing as a company that doesn't use steel, whether it's its building, its data center, no matter what. Every company adopted electricity. They adopted the telephone, then the internet, the computer. And of course, if you think like this of Bitcoin, every company will adopt Bitcoin in some way, shape, or form. Whether they adopt Bitcoin via a credit instrument that is backed by Bitcoin that replaces their commercial paper, their short-term cash. They're like, okay, instead of having short-term cash in bonds, we're going to have short-term cash in instruments issued by BTC Treasury companies. Well, sorry, that kind of means you're adopting Bitcoin, right? Oh, you're going to have an insurance company based slightly on Bitcoin. You're adopting Bitcoin. It's a technology. It's getting adopted. Everybody adopted steel. When steel became a thing, I always say this, but when steel became a thing, people didn't want to cross the bridge. They thought the bridges were ungodly. They thought the bridge wasn't going to hold. People didn't get that we could build a bridge this long. It was not possible. How would that bridge hold? It was going to collapse. right? And you had people for decades who didn't trust steel. And of course, Carnegie became the richest man in the world, right? Electricity, right? Same story. You had Edison trying to get people to not switch to electricity. He invented the word electrocuted, so people wouldn't convert. The internet. Think about, likely your parents, if you're younger, maybe yourself, if you're older, people didn't trust the internet. Don't buy something on the internet. That's crazy. That used to be crazy. So same for the computers, etc. So Bitcoin's the same way. That's Saylor's point. It's going to take a few decades for Bitcoin to be adopted, just like it did for electricity, just like it did for steel, just like it did for the internet. If you look at the internet, the story of the internet, the early days, the 90s, yeah, it was pervasive after 20 years, roughly, for the internet. Bitcoin, we're not at 20 years yet, right? We're not there yet, and it is already pretty darn pervasive, especially in more developed economies, Everybody's heard of it. Everybody's talking about it. The way we talk about Bitcoin today is very similar to the way we talked about the internet in the early 2000s. Slowly, then suddenly. If you remember the internet, early 2000s, that wasn't a thing. Late 2000s, pretty much just everybody had DSL and was talking about the internet, etc., etc. So eventually, the BTC is the revolution. And if it is the revolution we believe, eventually all companies will adopt it in some way, shape, or form, either directly on the balance sheet, either by holding, for example, the instruments issued by Strategy. They could hold those instruments issued by Strategy on their balance sheet. That would be another form of adoption. But adoption will happen, just like it did for electricity. And that's kind of my viewpoint here. So I agree with Saylor on this. I entirely agree with Saylor on this. What about all of the companies that don't adopt it yet? Well, they are late adopters. That's what it is. Anyways, this was not financial advice. This is not investment advice. This is only entertainment. I'm hoping you're entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.